I think it's an indication of what happens to an economy that is driven by liquidity, by artificially low interest rates. The coincidence of GDP declining by a greater than expected amount, and the reduction of quantitative easing, which is to say the reduction of federal government counterfeiting, with the governments allowing interest rates to increase, has had the same effect that reducing the amount of vodka in a college punch bowl would have. The party begins to slow down a bit. And really the consequence of higher interest rates and reduced artificial liquidity has had a predictable impact on the economy. The big thinkers, of course, have other interpretations, but the easiest interpretation is to look at history, and history would substantiate that point of view.
Now, the budget in 2022, the government of Canada just announced, it's intending to issue a US dollar denominated global bond effective April 20th. What do you think drove Canada's decision to issue a US dollar denominated bond?
The US dollar, despite its faults, is the deepest and most liquid market in the world. And assuming that Canada doesn't suffer a disproportionate economic decline relative to the United States, they can lower their borrowing costs by borrowing in US as opposed to Canadian dollars. While, as you know, Cassandra, on earlier shows, I have expressed some skepticism about the US dollar. That skepticism is concurrent with all fiat currencies. My friend Doug Casey says the US dollar is the worst currency in the world except all of the others. The US government securities market is the deepest, least opaque, most liquid financial asset market in the world. And assuming that Canada can manage the exchange differential between the Canadian currency and the US currency, denominating the bond, particularly in the amount that Canada is going to have to raise. Parenthetically, this budget is a disaster. It will substantially lower potentially their interest charge by issuing the bond in a deeper and more liquid currency.
Okay, so let's move on here. Corn and soybean prices have risen nearly to record levels. Do you think that this is a signal that higher food inflation is yet to come?
Yes, I do. It's important to note historically that food prices relative to the average household budget have been falling for 50 years. When I was born, admittedly a long time ago for you, food consumed almost 30% of the average household budget. And the so-called value add to food was much lower, meaning that there were fewer, processed foods, solutions, meals on sale at grocery stores, and the food budget was much more commodity-centric. Now that same number, which was formerly about 30%, is 15%. So what you're seeing is a slight reversion to mean. You are seeing global living standards increase, which is to say the bottom half of humanity worldwide has more income than they had 30 years ago. And the consequence of that is that one of the things they want is better diets for their families. So they're competing with you and I for food, which is ultimately a very good thing. The second thing that you're seeing is the impact of the green revolution, which is to say the technologically driven increases in crop yields around the world is slowing. The benefit that we got from irrespective of your political point of view, the economic benefit that we got from increased fertilizer inputs, as an example, more focused genetic technology and seeds, more effective, at least in the near term, utilization of pesticides. The rate of yield per hectare increases that we have enjoyed over the last 50 years is slowing. That isn't to say that technology won't afford us great advances in the future. It's just that the difference that we've seen in yields from the yields that we expected in the 1950s, which would be paltry by today's standards, and today's standards, has led to a global lessening of food prices, and that's stabilized. The second thing, of course, is that in looking at any equation, you need to look at the numerator and the denominator. It may be that inflation is as responsible as technology and trade for the increase in food prices. Certainly, there are increasing geopolitical tensions in grains. The disruption in the free flow of, as an example, Russian and Ukrainian wheat to global markets will have a near-term impact.
And this week, Russia halted gas supplies to Bulgaria and Poland for rejecting its demand to pay in rubles. What impact do you expect this will have on these economies?
Well, mercifully for those economies, winter's drawing to a close. It would have been really a challenge for those economies had it occurred in October. Energy prices historically are very, very cheap. And it's likely that the West will be able to muddle through even a hiatus in fossil fuels from Russia. But it won't be easy. It'll be extraordinarily unpleasant for those who have to endure it. It's certainly a lesson that policymakers in the United States and Canada need to take into consideration. The idea that the big thinkers of the world, the Bidens and the Trudeaus, adopt sort of the World Economic Forum narrative with regards to fossil fuel, which is very different from the needs of their citizenry. All of that needs to be rethought. The reliance, as an example, of Germany on solar energy, wonderful from a WEF perspective, except that the sun doesn't shine in Germany. And trying to operate Germany's grid on intermittent solar power when the sun doesn't shine has proven to be a challenge. I think the circumstance that you see with regards to geopolitical tensions in energy calls the question on global energy trades and global supply lines, whether or not the big thinkers want fossil fuels to be around or not. My suspicion is that peak demand for fossil fuels probably occurs in 2040 or 2045, and the world will consume between 90 and 100 million barrels a day between now and then. The big thinkers' preference is narrative. The fact that when you exit your nice apartment and go down the garage and want your car to start means that irrespective of the narrative, you're a fossil fuel consumer, and your needs are going to supersede their narrative, at least for 20 years.
Definitely. So what do you think the implications of all the geopolitical tensions are going to have on the supply and demand of uranium?
Well, it's interesting. For the first time in my life, I'm embarrassingly politically correct about uranium. It's not a part of the ideological spectrum that I usually inhabit. It seems that the winds are blowing politically in uranium's favor for many reasons. Security of supply being one. You probably won't remember because you weren't alive then, but the Japanese, an example, made the decision to emphasize nuclear power after the Arab oil embargo in 1973 because of the energy density of uranium. A small amount of uranium can fuel an economy as large as Japan's for 5 or 6 years. You can't store that much oil. You can't store that much gas. You can't store that much coal. And energy security is suddenly an issue which is coming home to roost. The other thing that really augurs in favor of uranium is the fact that you can generate large amounts of baseload power very predictably with no carbon emission. And so people who have hitherto been opposed to nuclear power for various environmental reasons understand it to be, in some senses, the least sinful source of baseload power.
Okay.
There are other societies who have chosen for practical reasons to sit out of the discussion. China and India come to mind. In countries like that, which are still experiencing energy poverty, which is to say where they have large proportions of their population, even in China, that have access only to intermittent power or to unaffordable power, those societies have come to understand that over the next 30 years, in order to advance their society, they have to say yes to all forms of power. Coal, yes. Oil, yes. Gas, yes. Nuclear, yes. And that's really the answer, all of the above. I have invested myself in solar power. I've invested in wind power, geothermal power, hydropower. Pick a kind of power. Many of your listeners would be shocked to know that 1.2 billion people on Earth have no access to electricity. Those people would want to live like you and I. Another 2 billion people on Earth experience energy poverty, defined as access to intermittent power or access to power which is for them unaffordable. Historically, the answer to that has been coal-fired power, the cheapest form of baseload power available. Political decision has been made, and I think in many societies for rightful reasons, that we need to phase out the ugliest polluters. The Chinese have stated publicly that 500,000 people a year die in China of respiratory illness due to particulate pollution, primarily from burning coal and oil and gas. The Chinese have said that they have no choice in terms of respecting public health priorities, while at the same time advancing the lot of the poorest of the poor in China, than relying on nuclear. And I think that's really where the debate goes.
Okay, so let's move on to gold here. According to the latest research from World Gold Council, physical gold demand increased by 34% compared to the first quarter of 2021. Do you think that the higher gold demand could push and sustain the gold price above $2,000?
Yes, absolutely. I mean, for two reasons. Remember that the purchasing power of the dollar is declining by 8.5% compounded, meaning that for gold to maintain its purchasing power against a basket of goods and services, it has to increase by 8.5% relative to the US dollar anyway. Even if the real value of gold, not the nominal value of gold, didn't increase, if the nominal value of gold stayed the same, it would be increasing at 8.5% compounded. And I think that's what's going to occur. The malaise in the gold price, I think, is very understandable if you have a sense of history. I remember a little bit the genesis of the gold bull market in the 1970s. I was young in the 1960s, but cognizant. And I remember that the signs of inflation were everywhere in 1968, 1969, 1970. But investors and consumers had lived through 2 decades of really benign economic experience post World War II, and they expected things to get better and better and better. A 5% rate of inflation or a 6% rate of inflation were things that you noted, and they aggravated you, but they didn't scare you until you had lived through 3 or 4 or 5 years of the impact of inflation, both in terms of how far your paycheck carried you, and also in terms of the deterioration of the purchasing power of your savings. It wasn't until 1972 or 1973, after 5 years of incipient inflation, that the truly pernicious nature of inflation became apparent to consumers and voters. And I suspect that's the circumstance that we're in now.
Okay, so one more question before we let you go here. Now that we're into earnings season, what stories are you following closely, Rick?
Well, I think the whole resource space, all of it, is going to surprise people. 2.5 years ago, we were talking about $30 US oil prices. Now you put a 1 in front of that. We were talking about, at least in terms of Canadian natural gas, AECO, the price was 0. The price is at $5.50. The amount of free cash that oil and gas producers are going to be able to continue to distribute and generate is enormous. I mean, truly enormous. And right now we're in a circumstance in the oil and gas business, as an example, that the investment community, having been punished so severely in oil stocks over 2 or 3 or 4 years, isn't letting the companies reinvest substantially, which means that cash will be available either in increased dividends or in increased share buybacks, as an example. So I think that you're going to have balance sheet and earnings surprises in the oil and gas business. I think you're going to have insane shocks in the coal business, which people think is going to go extinct. It's far from it. And I think that you're going to see continued surprises to the upside among gold producers. I think you're going to see, absent a global recession or depression, I think that you're going to see, not just this year, but next year too, major surprises, positive surprises on the earnings, and in particular on the balance sheet improvements of major commodity producers, including precious metals producers.
Okay, perfect. Well, thank you so much for joining us today, Rick. Before I let you go here, do you want to let our audience know where they can go to get more of your commentary?
Thank you for that opportunity. Any of your audience that care about my thoughts on natural resources are encouraged to find them out. Go to a site, ruleinvestmentmedia.com, list your own natural resource stocks, and I will personally rate them. No obligations, absolutely for free. 1 to 10, 1 being best, 10 being worst. I will, in addition, comment on those issues where I think my comments might have value. And given that I've now given up my securities licenses, which is to say I'm unregulated, if any of your listeners care what I'm doing with my own money in terms of private placements, I can tell them in the question or comment section, write placements. It's absolutely free. I'm not soliciting because I don't get paid. I'm not a solicitor.